Boost your credit score, get lower mortgage interest rates. If you could lower your monthly mortgage payment by using your credit cards in a certain way, would you want to know how? I'm Jill Shepard, and I'll walk you through the actual guidance our team of experts gives to their clients on lowering their interest rate by improving their credit. Plus, I'll share a secret for bumping up your score that most people don't know. We talk about home loan strategy a lot, but what does that really mean? One thing it means is looking at your credit score closely to see how it can save you money when buying a home. If you don't know your current score already, get it, so you know where you stand. Your credit card company may provide your score on your monthly statement, so look there first. If not, it's free to check your credit once each year directly from the credit reporting companies. It's good to check your score so you know where you stand, and so you can catch any mistakes or errors it may have. Okay, so you know your score. Let's do a short overview on credit scores. Scores range from the 500s to 800s, and 620 is about the minimum credit score for many mortgage loans. The most important factor is this: the higher your credit score, the easier it is to qualify for the lowest possible interest rate. A lower rate can lower your monthly payment and save you money. So, if you want a lower rate, raising your credit score can help. Here's something most people don't know. Credit scores are tiered. These tiers are 20-point increments. Which tier you're in is what matters. Each higher tier gets better loan pricing when you go to get a mortgage, which means a lower interest rate and less for you to pay each month. So, what can move you up a few points to reach that next tier? Revolving credit, aka credit cards, makes up to 30 to 70% of your credit score. So using credit cards in the right way can help you score. The secret for bumping up your score with your credit cards, as told by sites like nerdwallet.com, is to use only 10% of your credit card's available credit. 10%. If you've got a card with a credit limit of $1,000, then only spend $100 on that card each month. That shows you have credit, but not a lot of liabilities, and thus improves your score. If your balance was instead $900 with a $1,000 limit, you'd be hurting your score. Some people mistakenly think credit cards hurt their credit score, and so they think they'll have to get rid of them. Definitely don't ditch your credit cards. That usually makes things worse. Instead, keep your cards, but make sure you're never using more than 10% of your available credit on them. If you don't have several credit cards and need to build up some credit history, open a few cards and use them regularly. Just don't spend more than 10% of the available balance on each one. A lot of people mistakenly believe they have to go into debt and thus pay interest in order to build up their credit history. But this isn't the case. Using credit cards correctly and paying them off in full every month can build up a credit history without paying interest. So, boost your credit score to save more. The higher your credit score, the lower your mortgage interest rate can be. To raise your score, use a few credit cards at 10% of their available credit. If you have any questions, just ask. Oh, ask them in the comments below, and our licensed loan officers will guide you to accurate answers. I hope this video gave you some good ideas and even saves you some money on your next mortgage. If so, give us a like, click the thumbs up icon, and subscribe to our channel. We have so much more help and expert tips to share with you. Thanks for watching, and I'll see you around.